Hey there, welcome back to the channel. Going to talk about some of the moves in the stock market lately, recently in the last couple days. So come on back. Okay, so we're going to talk about some of the moves in the stock market. We've had all this kind of controversy out there of basically we had some stocks like the GameStop, AMC theaters, and a bunch of other stocks that have like had these incredible moves. And what's happened is that these stocks apparently were heavily shorted by someone. You know, everyone suspects it's hedge funds, but who knows? It could be CalPERS. You never really know. But yeah, so these stocks are shorted. And so let me just go over some really basics first, and then we'll talk about this. So first of all, what is a stock? A stock, when you buy a stock and you're buying a stock, and it's not, if you're buying like a normal stock that's not like a class B share or some kind of weird special thing, because basically they can take stocks and they can sell stocks of any type they want, right? So this is like with the Google, right? The Google has like A shares, B shares. Other companies have done this too, and what they're doing is they're basically setting up so they can sell a lot more shares to people, but maintain control. For example, in some structures, like an A share might give you one-to-one voting rights, whereas like a B share might give you no voting rights or like 1 out of 10 voting rights. And so with that kind of structure, it kind of maintains control at the top, because what they'll do is they'll float very few of the, let's call them A shares. So ignoring all that, normally what you have is you have a company. So let's say a company makes $1 billion and they sell 1 billion shares, okay? Now, and what that means is that, hey, if they make $1 billion and they have 1 billion shares, the earnings per share is $1 per share. And what that means is if you have 100 shares, then they've earned $100. And then now normally, so, okay, your share has earned $100, right? Because you $1 per share times 100 shares. Now, the thing is, so in the scheme of things, this would be like if you had a small business and you and your buddy are like, hey, let's start a business together and we're going to go 50-50. It's like, okay, so if your business makes, you go into a partner with one other person and you each have half ownership and you make $100, well, you each get half, right? So $50. So the same way with a stock, a public stock. So if you had a company that sold 1 billion shares and they or had $1 billion worth of earnings, $1 per share earnings, then you would, your share is that $1. Now, they don't always pay it out, and most companies don't pay it out, but potentially there's that where they could decide to, hey, pay a dividend and pay out that $1 a share directly to you as a shareholder. So the thing is, so what you're trying to understand is like a stock is this ownership thing. And what happens is in the old days, people tend to hold them a lot longer. And modern times, people don't really hold the shares very long. Like you can imagine that, well, and still people do hold them a long time, but the people that hold it are like normally the ownership people. So, your Bill Gates with Microsoft, your Elon Musk with his companies. They tend to hold these a lot because these represent ownership interests and also control, because they have the largest shareholders have the most control over what the company actually does. So what is a stock valued at? So, well, it's valued at basically the earnings that it can make, right? So because the way that you look at it is like, how do you get paid? If you take $1,000 of your hard-earned money and you go take that, well, or you take a stimmy check and you buy some shares, you still want to get paid for your money. You're using your money to buy these shares. You're basically investing in that company, and you're allowing that company to use your money in a way, right? Especially like on an initial public offering, that's directly the case, right? On an initial public offering, when you're changing in the secondary, it's not quite as clear, but it's still the same thing, right? So it's this ownership interest. So now if you buy a stock, you're what's called long. So you're long the stock. It's just, and there's a couple things. You own the stock, you own it. You don't necessarily have to own it outright. You could have borrowed money, aka been on margin to do that. But generally, you own the stock. And generally, if you buy the stock at $10 and it goes up to $20, you make money, right? So basically, you're long, meaning that just think of long is you benefit if the price of the stock goes up. Now, there's another side of the coin that Wall Street has called going short. And the way going short works is you have the option of borrowing shares. So for example, I could go to you and say, hey, let's say you have 100 shares of a company. And I say, hey, can I borrow 50 of those shares on margin? And so what happens? Well, I pay you a margin rate to borrow your shares. And what happens is I sell those shares. So I don't own those shares, but I sold them. And what the point of that is that, I borrowed your shares. Now this all happens at the broker, right? And so this is one of those things where, hey, when you have a brokerage account, you sort of have an entry that says that you own the shares. It's not like totally true that you don't totally own the shares. But going back to the point, people can borrow the shares and sell them without owning them. Now, what happens if you sell the shares at $10 and you're on the hook to return those shares? So that's the key. I borrowed the shares from you. Let's say I borrowed 100 shares from you. I have to return those 100 shares at some point, right? Very simple. I have to return those 100 shares. Now, I sold those for $10 a share. Well, I need to go out on the market and buy those shares back to return them to you. So let's say if the stock goes down, to $5 and I sold them at 10, then what happened? Hey man, I just made a 50% profit, right? I basically can go on the market and buy them for $5 and give those shares back to you. And so basically I sold them at 10. I bought them back at 5. I made $5 per share profit minus the commissions, right? So that's how shorting works. And that's how you can make money when a stock goes down. And now making money when it goes up, it's just sort of a more direct thing. You buy it at $10 and then you want to hold it for a while and it goes up to 20 and you sell it. Well, you make money because you sold it for 20 and you only pay 10. So a couple things about shorting. Shorting is very often demonized. And it shouldn't be demonized because it's a very important thing. You can imagine when you've had these stock market crashes and the market is just going down and everyone's selling. And you saw this like in March of 2020 when they started the lockdowns and all that stuff. You basically have a situation. Who's going to come in and buy shares? Who's going to buy shares when things are just dropping off like, when you're going limit down. Who's going to buy shares? Well, if you're short, you're going to buy shares, right? So let's say you short a stock at $50. Well, okay, I sold the shares at $50 and now it's at $40. Well, I'm $10 in the money. So there's an incentive for me, significant incentive for me to go out there and buy those shares that are down $10 to buy them at 40 so that I can return those shares, right? And then in addition, when something's really crashing, they have that, you can always look at that statement where it's like, hey, the bulls make money, the bears make money, the pigs get slaughtered, right? So basically it's like, hey, look, when the market's really crashing, let's say you had sold short something at $100 and now it's down in the $50 range. You got a 50% profit there. You'd be a doofus and a pig to not go and buy some back to cover those shorts, right? And so this is exactly what happens. And you see this at market bottoms in stocks and whole markets. You see these aggressive moves off the bottom. And a lot of that, I believe, is due to short covering because people go down there and they're like, hey, I'm $50 in the money. And then it starts going up and you're like, oh my gosh, I'm losing my money, right? So they're going to rush out. And when they go to buy, they almost like are ready to buy at any cost, right? Because they're like, look, I have this profit. So even if you're sitting there, you sold short 100, you go buy it back at 50, it starts moving on you. You can't get it back, can't get it, and then it goes to 60, and then it goes to 70. Well, look, you're still happy to sell it at 7, to go and buy it at 70. So now, if you're a person that looking at from the long side, you're like, well, what moron would go and buy stock at 70 that just moved up, let's say, in a very short period of time from 50 to 70? It's like way overbought. It's out of control. But if you're on the short side, you may really want to do that because you're like, you want to lock in your profits. So now, imagine if you're not in a good position, let's say you short at 100, okay, and now the thing's at 120. Well, now you're in a really predicament, right? Because think about it. I have to return these shares and I can't get the shares. The only way I can get the shares is to go on the market and spend 120. So now I'm down $20 a share. Oh my gosh. And think about it. Let's say it's moving like some of these short squeeze stocks, the GameStops of the world. They're moving and they're moving a lot. Well, theoretically, if that stock goes to 1 million, you're on the hook for the whole million. It never stops. See, on the downside, when you buy a stock and you're long the stock, you can lose all your money. It can go to zero and be worth nothing, right? But on the short side, it could theoretically go to infinity. Now, in a practical manner, that won't happen. But what has literally happened in GameStop and some of these other shorted names is that it's literally gone to infinity. In effect, going from this to like, going up, 100%, 200%, this is incredibly painful. And the thing to keep in mind, if you're short that, the broker is managing your position. The broker is not going to be sitting there because remember, you're short those shares. That broker owes those shares to the customer that you borrowed them from. So they're not going to sit there and let the stock move against you 100, 200 without you putting up more money or closing your position. Because think about it. What really happens is, hey, I'm long 100 shares of GameStop. Well, I didn't know. You wouldn't know that, hey, by the way, they lent out your shares to someone. And they're gone, and the broker doesn't have the shares. The shares were sold, right? So what really happens is you just have an entry in your account. Now the broker is going to be like, look, I still owe these shares. Like I need to owe these shares. So the person who short that, they're going to put margin calls on them. If that moves up too much, they're going to put margin calls on and be like, hey, you need to put up money, or you need to cover your position, and so that will put additional pressure on the people that are short to basically go out there and at any cost buy it. And so that's exactly what's happening. So you basically have a situation, if you look at like GameStop, as far as I can tell in a fundamental sense, it's like really bad. It's just kind of a bad model. It's like, I remember going there like 5 years ago with my son. It was like, it's just kind of a bad model. I mean, I think the only business that we're driving was that like people like selling used games and that kind of stuff. And I don't think there's a lot of money in that. But I think people would do that. And now with the models where you can just rent games and other stuff, it's just sort of been a terrible business, right? So of course, what are the smart people that are, hedge funds and people that are doing the research are like, oh, this company's going to go bankrupt, so therefore I'm going to short it, right? Once again, hey, shorted at $20, it's going to go to zero. And then I don't have to pay back, right? It went to zero. Then I can go, usually you buy back on the pink sheets. It'll be 10 cents. It's like, great, that's a $20 profit. Minus 10 cents. That's all good. But the problem is, so what's happened apparently is that, people have caught on to this. Now, they have to report their short positions. You don't necessarily know who it is, but you have to report their short interest. Now, part of the reason for this is that there has been abuse. Okay. So conceptually, if a company has 1 billion shares out, the maximum amount of shares that can be borrowed and sold should be that 1 billion shares. But in practice, we've had this Reg SHO and all this other stuff. And what's really happened is what they call naked shorting. And what's happened is companies have been allowed to, or in effect done this, where they short the shares, but they never borrowed them. So you can imagine it's like, hey, I go into my account and I just sold short 1,000 shares of Tesla. Okay, great. But you didn't borrow the shares. The shares weren't available. You just sold them. Well, what happens? The selling pressure is still applied to the market. It counts as a sale, all that stuff. And yeah, you're on the hook for these 1,000 shares. But if your broker isn't like watching you like a hawk and making sure that you have the money to get these shares back, or to make sure that, they had the shares for you to borrow in the first place, you basically get in a situation where you have, let's say there's 1 billion shares out. Well, maybe there's 1 billion short. That should be the worst case, but maybe they accidentally sold short 2 billion shares. So now think about it. You have a stock and it's got a float of whatever, 1 billion shares, and it's got 2 billion short. And now all of a sudden someone decides, like on a news group, whatever, like, hey man, let's go long. Now, see, the thing is, they know, because they have to report their short positions, and that's for a good reason, because hey, you're borrowing this stock, and we've had all these problems where, like Reg SHO, they're supposed to report this, and we've had companies that have been on this list for years where it's like, hey, the numbers aren't adding up. In other words, if the company has X amount of shares floating, there's still more shares short than are floated. So there's something going on there, right? And this has been a continuous problem. So now what appears to have happened in relation to GME and some of these other companies, and this is not new. This goes back to the 2000s and ever. I remember this. I mean, people had this, they still have this service where they're like, hey, we'll report to you the short interest. And why do they report to short interest? And why do people pay money for that, to get this information? Because they know if there's a bunch of shorts, like if you have, so the way they'll usually, they'll describe it in 2 different ways. One way they'll describe it as the days to cover at the normal volume, and the other way is a percent short. Like if you have 100% short, that's a huge amount of shares short. And those people are in a situation that are short. Like if that price starts going up, they're going to get margin calls. And the other thing is, it can be expressed as a percent or as a DOC, days to cover. And in days to cover, you take the normal trading day. Let's say the shares trade 1 million shares a day, and there's 10 million shares short. Well, you divide that out, and it's going to take you 10 days of the normal trading volume to cover those shorts. So you can imagine 10 days of all short covering demand on top of the regular trading, you're going to get price pressure up on that stock. And so basically, apparently it's all kind of being blamed on this Reddit and this stuff. And whether that's true or not, I don't know. But the point is, if you're sitting there and you're a hedge fund and you overshorted the stocks, I mean, you always have that risk, it's just what it is. So I guess a couple things. First, the thing is, we need shorting. So that this is one thing that happened back in the financial crisis. They were like, they banned shorting. They banned shorting on financial companies. They banned it on, then they get to the car companies. They just went round to ban it, shorting on all these different companies. And that actually made the problem worse, because basically if people aren't shorting, you have no natural buyers. Like if you're in the market and you're like, hey, look, I don't want to buy anything right now, everything's overvalued, well, you're not going to do anything. But if you have a chance to short, then you can short. And then the result is, if you're short, you're a natural buyer. So any move down in the market, you're a natural buyer. So it's an actual stabilization. So these moves are kind of historic in GameStop and some of these other ones. It's certainly all planned. But I think a couple other things to point out is, like, look, this isn't some conspiracy. This is just like, you're very vulnerable. I mean, the hedge funds are supposed to be professional. They know what they're doing. Hey, you're vulnerable. Go watch The Big Short. Those guys were short, and it cost them a lot of money to stay short, and short the housing market. Right. And they were getting screwed over too. But you know what? It was a risk that you're playing. And that's just how it works. I mean, Wall Street is Wall Street. It's kind of funny that these big professional players got caught with their pants down by what appears to be just little people. It's sort of like payback is a bitch, right? It's like kind of funny. But in these kind of things, when you have this market volatility, you have to just let it trade. You really have to let it trade. Like you start preventing trading and all that stuff. It just makes any problem that's there worse. Look, eventually, you will run out of buyers. You will just naturally run out of buyers, and then these will probably be good shorts again. I'm not a financial advisor. This is not financial advice. It was interesting. I was looking at some of the calls and some of the puts, and the problem is I was like, oh man, I know this thing's up in like 320, and I'm like, oh man, I'm going to buy some puts. And then I stopped myself because I realized and I know this, but I have to, protect against emotional moves. I'm like, but here's the thing, I'm paying like 500% implied volatility. So the problem is they're all expensive. Even the puts, calls, everything's expensive. So basically the way it works is because of the moves in the stock, the price of all those options, which I'll have to explain another time, but the price is very high. So here's how it would work. If I had bought the put, and I bought it, like, let's say if I bought it at 320, and let's say the stock goes down to 150, gosh, I'm 150 in the money, right? Well, no, at the same time it goes to 150, if the volatility implodes, the price of that option will drop and I'll not make money or lose money. So that's the problem with options. So it's not really easy. It's better to kind of like, properly swing trade and kind of avoid the over stuff unless you're watching it. You basically have to be ahead of the game, and ahead of the game means that you've looked at something and you got buy point, exit points all planned out. And then if it goes away, you make some money. If it doesn't, you limit how much you lose. That's kind of how the game is. So I think I'm rambling again, but so coming back around to summarize, this has been really interesting to watch this. And I think that, it's interesting how, and I know Rossman on his channel had kind of been complaining about how they're now demonizing these people, like calling them this, that, whatever, racist, everything. And of course, I agree with them. That's 100% wrong. It's like, look, you got 4 million people. Are there some racists in there? I'm sure there are. But you can't classify everyone as racist. And I'll say that the hypocrisy is so deep because it's like, on one hand, it's like you have this liberal kind of ideology where it's like, look, all people are racist, or all people that aren't people of color are racist, and therefore they're bad. But then on the other hand, it's like, and this method, this kind of view as well, this ideology that, we need to, rich people are bad, right? It's kind of like rich people are bad and we need to tax them or whatever. But then it's interesting, all of a sudden it comes together where a bunch of just average Joe people end up getting together on a bulletin board and end up taking money from large hedge funds, which are the 1% or 0.1%. And all of a sudden people are bashing them like, oh, these are racist and bad guys. And it's like, really? So the hypocrisy in the media is just amazing, because it's like, on one hand, it's like, wait, 5 minutes ago, the 1% were evil, bad people. And now all of a sudden you're defending the even bad people, even the bad people when they lost some money. So what is it? What is it? It's like, give me a break. So yeah, it's quite interesting to watch. In a way, I wish I had a little more time to work and trade it, but it's just, it just moves too fast. So, I think when you look at these things, volatility can be like, sometimes like volatility will be something that will be transitory, and it will be you go through a volatile period, and it'll be a consolidation period, and sometimes and then it resolves and starts trending again. That can be trending up or trending down. But other times it just kind of like volatility is sort of a sign that, it's you're getting closer to the end of a move. And so the cases here, I don't know. I just tend to think that there's probably more to the move, and this is not financial advice. From my point of view, I'm sort of thinking there's more to move, because like, look, at some point they're going to get more stimulus out, and this money that's what this shows you. What this shows you is this is the Robin Hood, Weeble crowd that are just out there gambling with their money, right? And so if you get another $2,000 or $1,400 to these people, oh, they're just going to pour it into the market. So, so I think there's much more to run until that ship has sailed. So, yeah, so that's kind of interesting, fascinating stuff. You can look at the charts yourself, and you can go to the channels where they have the charts. I won't show you the charts here because it's just kind of like silly. But what I would say is I think the move's over. Like, there might be more volatility, but if you're sitting there thinking like, oh, I just heard about this move and that move in any direction you wanted to pick for it to go, it's probably not gonna. You'll probably lose money, probably. And because why? Because it's really historic high volatility, and in either direction, meaning that it could like stabilize going up or stabilize going down. The volatility, I mean, volatility is like an explosive. It goes off and it just can't keep going because it gobbles up all the resources. Like, if you have an explosion, well, you ran out of explosive, you ran out of oxygen, oxidizer, you ran out of all the stuff you need to have the explosion go. It just runs out because it's such a fast reaction, and that tends to be what the case is. So like anything that you would do, and I don't know how to do this, would be if you were going to mess with them, it'd be reduced to what? Something that would be trading lower volatility in them because the volatility is so high. And the only way you could do that would probably be the professional guide, not financial advice, would be like, so now it's like, it's very interesting because some of these, the people that write all the options have probably, taken some pretty some losses in here because, right, they'll write a call for $100 from the current price and, oh crap, they had to pay out on it, right? Or they'll write it $100 lower than the current price for a put, and then, oh crap, they have to pay off on it. But what'll happen is they will regain control, right? Because they'll keep the pricing up there as high as they can because they just won't sell them to you. And then they'll just start making their money back that way, any losses. And that's kind of the good long game when you're talking about options, is that you sell the volatility, right? So the problem is, like, in general, it's like most options expire worthless. So if you're the person that wrote the option and got the commission and then never had to pay out, that's the best position to be in, right? But the problem is you have to have like margin account, and I don't know what kind of special privileges you need. But I mean, there is a risk because you have these volatility. You have to have resources, right? You have to have resources because if you were someone that was writing a bunch of calls against these particular stocks like GameStop, you probably got yourself in a world of hurt, and so you need the financial resources to kind of go through it to get back to your money making thing, right? So I think that's it for this one. If you're messing around with that stuff, watch out for it. It's pretty much amazing fireworks. I'm trying to think to myself, like, is this more volatile than like the late 2000s stuff? Because I was around and I remember I was with a company, General Instrument got bought by Motorola, and it was like that stock. I mean, they bought us at like what, 20-30% premium above the stock, and then that stock continued to go up. I mean, we were in there at 90 and the dang thing kept going up. And then I remember in 2000, we were trading the would just like, it was no matter what it was, you just waited and they would get around to whatever like industry group you wanted. And I remember it was so funny. It's like, oh, they're on this tech stock, they're like on the pet store and this and that. And then they're like, I bought into some superconductor companies, right? Because they're going to get to these guys, and then never did. And then finally, like, oh yeah, they got the SCON, superconducting technologies. I think they're still around actually, but it's funny. They got to, and it's like, oh, it goes from $5 to $30 in a week. And you're like, oh yeah, cool. So they always get around to your part of the bubble when it's just going crazy. So, but I think this volatility is even more volatile. I think these moves are even more. These are definitely larger percentage moves and price moves than I think I remember seeing back in that day. So wild times. Enjoy it, relax, chill out, just whatever you're doing. If you're messing with that stuff, I mean, I'm not a financial advisor, not financial advice, but just be careful. All right. So that's it for this one. Peace out. Bye. Out.